Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for July 2017. Let's take a look at key highlights of June. India's GDP growth rate slowed to 6.1% in the fourth quarter of 2016-17 from 7% in the preceding quarter, mirroring impact of demonetization on key sectors. Retail inflation declined to a 5-year low 2.2% in May from 2.99% in April, according to data released by the Statistics Office. RBI Monetary Policy Committee voted 5-1 to keep repo rate at 6.25% and revised the inflation target to 2 to 3.5% for the first half and 3.5 to 4.5% for the second half. Prime Minister Modi made his first visit to the US under Donald Trump. Trade and terrorism were the priority topics discussed. India faces a cumulative loan waiver of Rs 3.1 lakh crore, or 2.6% of the country's gross domestic product in 2016-17. Brexit faces yet another speed bump as Britain saw a shocking result in their election in a hung parliament, with Conservative Party still retaining maximum number of seats. The US Federal Reserve forged ahead with a 25 basis points interest rate hike and additionally plans to tighten monetary policy despite growing concerns over weak inflation. Political drama from the White House continues as James Comey testifies in front of the special counsel and indicates Donald Trump's involvement in the Russian hacking. GST implementation will be a key thing to watch out in the beginning of July, along with progress of monsoon and impact of farm loan waivers. Going forward, we believe that upside in Nifty will be led by earnings growth. We estimate that earnings could grow by 15 to 20% over the next 2 years. Extremely low volatility in both global and Indian markets indicates complacency as one of the key risks. EPS estimates for Nifty Index for financial year 18 and financial year 19 are Rs 523 and Rs 639 respectively. As per blended estimates, Index is currently trading at PE of approximately 17.3 times 1 year forward. This makes the index priced not too far from its 5-year PE level of 15.9. Any correction in Nifty should be bought in. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. Going forward, repricing of fixed income portfolios at lower yield poses one of the biggest risks for investors. Investors should revisit their fixed income allocation and should rebalance their portfolios by investing in long-dated buy and hold strategies, preferably with low interim cash flows and instruments which can potentially benefit from rating upgrades and spread compression. We recommend investors to allocate 100% of their fresh fixed income allocation to accrual or buy and hold strategies.